Hello and welcome. I'm Roger Pine from Plan. I'm here with Jeff Levine. He is the Chief Planning Officer at Buckingham Strategic Wealth. He's also a member of our team at Plan as our tax planning strategist. Jeff, good to be with you, friend.
Hey, good to be with you as well.
And the goal of this video is, in fact, to be part of a series. Our thought is we'll do weekly or so episodes where we talk about tax, try to keep them under 15 minutes or so, and just cover something that has come up during the week or something going on regulatory wise or legislation wise that we think is worth sharing on the tax side. And this week, we're going to talk about it sounds small, but it's bigger than we thought it was, the $300 above the line charity deduction. It was introduced in the CARES Act in 2020 in response to the onset of the pandemic at that time. And we made some discoveries about it. So we'll get to that in a second. But yes, $300 above the line charity deduction if you take the standard. So you can take the standard and still get a deduction for charity. That's what's new about it. It was also above the line. So it didn't just impact your standard deduction. It also impacted things like Social Security taxation. And, because it impacts AGI, some of the other things downstream of AGI. Subsequent to the CARES Act, there was other legislation where it was kind of weird because it was $300 if you were married, joint, or single, or head of household. It was $300 across the board, which I think they just rushed it through and missed it. So for 2021, they came out with and said, okay, $600 if you're married filing jointly. And what was that, Jeff? That wasn't CARES Act. That was another legislation
That was
passed.
the Consolidated Appropriations Act. That was that budget bill that they kind of slammed through at the end of 2020, right at the end of the year.
Got it. And when that came out, all of us just kind of saw it. Every article I saw and every software company saw it, and they said, okay, they raised it from 600 or from 300 to 600 for married filing jointly. Fix that, and you're all done. And that's how we left it until like last week. So last week, one of the advisors on the Plan platform reached out to us via support, and this got escalated to me very quickly, and I escalated it to Jeff real quickly. And they said, "Hey, when are you going to fix it? Because the 600, the 2021 charity deduction that you can take with standard, it's not above the line. It doesn't decrement AGI. It's below the line." And I mean, we were kind of like, what? That's not what anybody had ever said before. But this advisor then presented some pretty compelling.
Roger, you're kind of being nice, right? I mean, at first I said like, this guy is totally wrong. There's no way this is right. Roger's being nice. He's kind of covering for me here a little bit.
Right. Yeah. I mean, like I've learned in this time that I've been working at Plan to like never totally dispute some tax idea that comes from an advisor. Sometimes I get crackpot stuff, but sometimes there's something accurate in it. And in this case, yeah, we sent it back to him and said, like, do you have anything, like, where did you find this? And they presented, I would say, pretty compelling evidence in the form of the 2021 draft Form 1040, which clearly puts this as below the line. So that was a quick code fix we had to do. What we learned was for 2021, it didn't just increase it from 300 to 600 for married filing jointly. It is, in fact, now a below the line deduction. So all those cool things that you get with respect to it being above the line last year, that's primarily that impact on Social Security taxation was a big one. That's gone now.
Medicare, and then, Magi, like that.
Yeah, anything related to Magi, AGI stuff is also gone. And so I don't know, but I guess one question I have, Jeff, we'll talk about the planning implications, is like, how did everybody miss this? Because I really think everybody missed this, right? Like everybody.
If you Google like the articles or whatnot, not that Google is the end all and be all, but you'll see basically every ultra reputable publication, all the research that I did initially into this was showing, hey, we've extended the charitable deduction, but we've expanded it to $600. And if you look at the nitty gritty of the legislation, the initial CARES Act language impacted the section of the tax code on AGI. And then this new Consolidated Appropriations Act didn't actually, when I went back, it didn't actually say like strike 2020 from the CARES Act and make it 2020 and 21, which would have been the easy way to do this, and make it $600 in the case of a married couple filing a joint return. That might have been the way we would expect to see that if indeed it was just an extension of the initial law. But this was, it said, hey, that section on itemized deductions, let's take the I think it's section 170, and let's just make that in the case of someone who files a standard deduction or takes a standard deduction, let's make that 300 for single filers and 600 for married couples filing a joint return, which, as you mentioned, really impacts planning perspective from the fact that it doesn't reduce AGI, which so much of what we do in the tax world is really key to. Very little is actually key to the taxable income number, just really your tax brackets and your QBI deduction. Those are kind of the only two things that are really impacted by that end of the game score, if you will. But that AGI number is essentially for everything else, like all the credits that get phased out, AGI based or MAGI based, right? A derivation of AGI. The thing that I think is pretty interesting, though, about this in particular is that this is now the second deduction in what we might call a brand new category of deductions. And you called it, you said like, hey, it's kind of like a below the line deduction now. It is and it isn't, right? Because on one hand, it is truly below the line if we say the line is AGI, and this is below that. This happens after that. So it is definitely below that line. You can't argue with that. But traditionally, below the line deductions have been synonymous with itemized deductions, right? You weren't able, you were either choosing your standard deduction or you're getting to itemize, but not both. And then in 2017, effective for 2018, the Tax Cut and Jobs Act created the QBI deduction. This, all of a sudden, this brand new type of deduction, which for a while everyone was calling a in between the line deduction, and which I began to call a below the line deduction, right? Because if you look at the tax reform where it is, it's really like, hey, take your regular AGI, right, which is already taking into consideration certain things like IRA deductions and SEP IRA contributions, self-employed health insurance, all those types of things that get us to arrive at AGI, at the line, quote unquote. And then below that, take your standard deduction if you want. And then below that, we can take these other deductions. So now we've got QBI and we've got this $600 or $300 charitable amount. And one of the things that I'm really interested in is this an indication that this could be the way that we continue to alter the tax code in the future? Are we going to go further down this road of, hey, we don't want to make you itemize in order to claim this, which particularly now is a big deal because of the Tax Cut and Jobs Act roughly doubling of the standard deduction, right? Like very few people, in fact, less than 10% of all taxpayers itemize now. So if you want to give people an incentive to do certain things or give them a little break, making it an itemized deduction doesn't really help all that many people. So are we now in a new phase where effectively we're going to create this third group of what, again, I've called below the line deductions? Or is this just kind of a temporary thing, maybe while we have the higher standard deduction? So it's yet to be seen. It's something that is definitely on my mind for sure.
Yeah, that's a great point. Yeah, 3 categories of deductions to confuse CFP candidates in the future.
Yeah. In the past, QBI was kind of in a world into and of itself. And in fairness, if they don't do anything at the end of this year, going into next year, it will once again be in a category in and of itself. But maybe not. Maybe this gets extended again,
Yeah. So planning implications. I mean, this never was a huge high dollar move. Now, that said, when it was above the line, if this person was on Social Security, you could move AGI by potentially $1,000, right? Because if they're in the 85% Social Security bracket, it would have been a bigger deal back when it was above the line. Now it's just less of a good deal,
Yeah, I
really.
mean, or if you were right on that Medicare, IRMA threshold,
Yeah.
and all of a sudden taking a, $300 deduction got you, right below that, you might be
Hmm.
able to save some big. But yes, in fairness, it wasn't a huge thing. But look, it's one of those things that when you're giving advice to clients, you want to be up to date on the, what's going on. You want to be giving them accurate information, and so. I certainly, without naming names, I can say that I've run this through a number of different tax softwares and not accounting for it properly in terms of their planning. And in fairness, like we just updated our software recently too,
Yes, we
but
did
that is,
over the weekend, actually.
yeah,
Yeah.
yeah. Well, but that's the beauty of it, right? Like it can be done fairly nimble. And Roger, to your credit, you're like, okay, well, I guess I know what I'm doing this weekend, right? It wasn't something you
That
said,
was
well, it's
right.
a small dollar amount, I'm just not going to get to it. You said, let's make sure this is right away. And so it's there. And not only that, but it's also a matter of, well, doesn't this is just a 1 year thing, right? This isn't an ongoing deal, right? We've got something that needs to be in the software for 2020 only, 2021 only, and then in 2022 reverts back to effectively what it was in 2019. And that's the
Right.
the joy, quote unquote, of tax planning right now is you've got to handle all of these sunsets, and without good software, it's really tough to do that because you're just balancing so many different things.
So, Jeff, if you're an advisor with a client who gives to charity every year, if you're going to kind of do an order of operations, presumably a QCD is the number one if that's available to that particular client.
Generally speaking, yep.
And then two is just even if you file, even if you have never taken the itemized deduction for 30 years, save those
Mhm.
receipts because now you may want to make sure that you can justify that you actually gave to charity, something that they may not have done for a long time,
Sure.
right?
Yep.
That was actually one of the, we have this tax report that spits out observations that advisors can turn into recommendations. And one advisor recommended we added to that. It said basically, when I see standard deduction, tell people to save their receipts because it may not be something they were doing before with charity. Now, I don't know. You can tell me if saving receipts is really something one needs to do with charity at these dollar amounts officially, but just having it as part of your tax records is probably worth doing, especially if they weren't in the habit of ever reporting charity before. So still worth doing. I mean, it's
Yeah.
better than nothing, right?
Yep. That's right. Listen, when it comes to taxes, less is always more. And so it may not be a big dollar item, but you know what? It's also one of those things where when you take care of a $30 deduction for a client, they know you're going to take care of the $300 deduction or the $3,000 deduction, et cetera. So, the same way we all notice the little things and they give us confidence for the larger stuff. I
Yeah.
think this is definitely one of those things, understanding the nuances and knowing that, hey, if you're looking out for this small thing, I know you're going to take care of the big stuff for me. So it's still a valuable thing for advisors to be discussing with their clients,
Sure.
100%.
I just thought of one like extreme edge case, which is if you're an advisor who regularly groups major charitable contributions into alternating years using donor advised funds.
Hmm.
First of all, donor advised fund, as far as I know, not eligible for
Right.
this $300 or $600. I guess
Hmm.
now we were looking at 2021, the $600 thing. So donor advised fund is not qualified. Also cash only. Am I right about that?
Yes. Yep.
Yeah. So got to be cash, can't be donor advised fund. But what I was getting at is if you're an advisor who's got a client who's every other year grouping deductions so they can itemize, now there's like this other little wrinkle, which is in your standard deduction year.
Hmm.
Maybe you leave a extra $600. I
That's
guess the
right.
math should work out either way because either way you take the deduction. But if they're if they're giving to their church every week and that just wasn't happening because they were taking the standard every other year, you can now still take that $600 deduction. So it's just
Yeah.
worth looking at it a little more closely.
And you know what? Most people who are in that situation, they're going to end up giving $600 throughout the year anyway. I
Yeah,
mean,
you
if
get
you,
hit up
you
for
count the
money.
amount of times you're at the register and someone says, "Would you like to add a dollar for charity X of your choice?"
Yeah,
You probably end up with a couple hundred of those throughout the year, even a lot of people. So yeah, I mean and to your point, keeping receipts, like it's tough, right? You mentioned church. If you go to church, I know lots of people, they end up putting money in the basket that gets passed around and so forth. There's not really like proof of that, but just keeping a logbook of went to church this day and made this contribution. that's usually going to be, good enough evidence in and of itself for at this level of contributions. If
Right.
you're saying I went to church and I put $3 million in the basket, that is probably not going to fly.
Take a selfie with the money in the basket when you do
That's
that.
it. You, bags of cash, the cheese.
Yeah. Well, good. Is there anything we missed, Jeff? I mean, I guess speculation as to whether this thing will go away or not. I guess it seemed to have been pretty popular, and
It's a thing that reduces people's taxes. It's always going to be popular.
yeah.
So, look, could I see it being extended a little bit? I could. We're still in the midst of a pandemic. They're still trying to drive money towards charity, et cetera. And the standard deduction is still really high.
Mm.
So if I don't know that I'd say I think it's more likely than not. I think at this point, I still think it goes away after 2021. Haven't really seen it as being a big deal that anybody has brought up and said we've got to save this in the Democrat only tax package that we're likely to see later this year as a reconciliation bill. But it's one of those things that is just not significant enough from a budgetary perspective that it's going to be fought over all that much. So it could be something that gets thrown in there at the last second. We just got to keep an eye on it. It's going to be it's going to be an exciting year. And one of the reasons that I think people, it took so long to really figure this out. I think you'll probably read a lot more about this in the coming weeks as people go through the draft form and look at the legislation again and realize like, okay, well, maybe it's not really an extension. Maybe this is actually different, which it is.
Yeah.
I think, part of that is just, we've been hit with so much, right? I mean, there have been so many pieces of legislation on top of just real world things that we've got to be dealing with, like families and keeping people healthy and safe. It's been a very challenging time for planners of all sorts, and particularly on the tax front. CPAs just haven't had a chance to come up to breathe for, the better part of a year and a half now.
Yeah, man. Well, we're ready for things to go back to normal eventually.
Amen.
Normal by just normally it's just confusing instead of
That's
incredibly.
Right. Just get us back to regular confusion.
Yeah. Well, good. Well, Jeff, I appreciate this. I appreciate your time talking through this. This was fun. I appreciate advisors who are willing in the spirit of cooperation and sharing to bring this to our attention, that we had something missed. They were really cool about it. We got it fixed. We want other people to know about it. And it's not like a trade secret that a thing that, that's what I love about the financial planning community. And so thank you to everyone who's been involved in helping us get better and understand these things better. It takes a village to understand taxes. With that, I think we'll wrap. Jeff, thank you for your time. And we're going to be back with another one of these, we hope in a couple weeks, and maybe we can talk about some of that tax legislation that might be coming up. I think that'd be fun. Thanks, Jeff.
Thank you.